Every system has an architecture. Most people see the facade. This is what's underneath. $256 trillion. That is not the GDP of any country. That is not the combined wealth of every billionaire on Earth. That is the amount of money controlled by financial institutions you have never heard of, that no government regulates, and that have no obligation to tell you what they are doing with your savings. Right now, half of every dollar in the global financial system sits inside the shadow banking network, and the mechanism holding it all together is a market most people have never heard of, a market that moves $12.6 trillion every single day, a market that, if it freezes for 24 hours, stops the world economy cold. This is the story of the repo market, and it is cracking. You were told the system was fixed. After 2008, after Lehman Brothers, after the bailouts, the headlines promised reform. Banks got stress tested. New rules were written. Capital requirements went up. Dodd-Frank, Basel III, entire bureaucracies built to prevent the next collapse. And technically, that is true. The banks are safer, but here's what they never told you. The risk did not disappear. It moved. It migrated out of the regulated system and into a parallel financial universe that operates with almost zero oversight, zero transparency, and zero safety net. We did not fix 2008, we outsourced it. That line is worth remembering because it explains everything that is happening right now and everything that is about to happen next. Let me explain what shadow banking actually is, because the name itself is designed to confuse you. The official term is non-bank financial intermediation, or NBFI. That means any entity that creates credit, provides liquidity, or moves risk around without holding a banking license. Money market funds, hedge funds, private equity firms, private credit lenders, insurance company investment arms, pension fund leverage strategies, repo dealers, CLO managers, none of them are banks, none of them answer to banking regulators. But together, according to the Financial Stability Board's 2025 report, they control 49.2% of all global financial assets, nearly half. They are not in the shadows because they are small. They are in the shadows because they are unaccountable, and the firms running this system are not obscure. BlackRock manages $14 trillion in assets. That makes it larger than every economy on Earth except the United States and China. A single asset manager bigger than Germany, bigger than the United Kingdom, bigger than India. Blackstone controls $1.27 trillion, Apollo Global Management $938 billion, Ares Management $622 billion, Blue Owl Capital $307 billion. These five firms alone control more capital than the entire GDP of Japan. They sit at the center of the global financial system, and most people walking down the street could not name a single one of them, but here's where it gets worse. The engine that keeps this entire shadow system alive is the repo market. Repo is short for repurchase agreement, and it is the single most important financial mechanism you have never thought about. Every single day, $12.6 trillion flows through the US repo market. That is not a typo, $12.6 trillion every day. Here's how it works. A bank or hedge fund or dealer needs cash overnight. They pledge collateral, usually US Treasury bonds, and receive cash in return. The next morning, they buy the collateral back at a slightly higher price. Simple enough, routine, boring, even. Except this market is the circulatory system of the entire global economy. Corporate payroll depends on it. International trade depends on it. Every credit line your employer relies on runs through it. If the repo market freezes, the economy does not slow down. It stops within 24 hours. And the collateral that keeps this system running is not as solid as it looks. According to IMF research, on average, the same treasury bond gets pledged 4 times over. Entity A pledges it to Entity B, B pledges it to C, C pledges it to D. 4 separate institutions believe they hold safe, sovereign-backed collateral, but there is only one bond underneath all of it. This is called rehypothecation, and it means the repo market is a house of cards pretending to be a fortress. When one link in that chain breaks, 4 institutions discover simultaneously that they are exposed. That is how a small shock becomes a systemic crisis. That is how a plumbing problem becomes a depression, and we have seen this happen. More than once in September 2019, with no warning, the overnight repo rate spiked from 2% to 10% in a matter of hours. No one could explain exactly why. There was no geopolitical crisis, no pandemic, no bank failure. The Federal Reserve injected $75 billion the same day just to stop the bleeding. Eventually, it pumped over $500 billion into the system over the following weeks. The most boring, most technical, most invisible market in the world almost froze the entire financial system. And the cause was painfully simple. Too many treasury bonds flooding the market, not enough cash on the other side, and dealer balance sheets too thin to absorb even modest stress. Just a plumbing failure. And it nearly brought everything down. We did not fix 2008, we outsourced it. But 2019 was just a tremor. To understand what a real shadow banking collapse looks like, go back to September 2008. The reserve primary fund was a money market fund. The kind of boring, safe, practically a savings account investment your parents might have used. Guaranteed stability, guaranteed liquidity, except it held $785 million in Lehman Brothers commercial paper. When Lehman collapsed, the fund's net asset value dropped below $1 per share in the financial world. This is called breaking the buck, and it is supposed to be impossible. Within 48 hours, $300 billion in redemptions flooded money market funds across the country. Panic, pure, systemic panic. The U.S. Treasury had to step in and guarantee every single money market fund in America to stop the hemorrhaging. A single shadow banking product, one fund holding one bad asset, nearly destroyed the real economy. And the lesson the system learned from that rescue was not to be more careful. The lesson was that someone would always catch them when they fell. That is the moral hazard loop, and it drives everything. Every time a central bank rescues the shadow system in 2008, in 2019, in 2022, it sends the same signal to every player in that system. Take more risk. The rescue is priced in. So risk-taking increases, leverage goes up, complexity deepens, the next crisis grows larger, the next rescue must be larger, and the loop tightens. No one knows how to stop it, because stopping it means letting something fail. And the last time something failed, it almost ended the world. In September 2022, the loop nearly broke in Britain. UK pension funds, not hedge funds, not speculators, pension funds for teachers and firefighters and civil servants, were using leverage strategies called liability-driven investments. When gilt yields spiked after Liz Truss's mini-budget, margin calls cascaded through the entire system in hours. The Bank of England had to buy £65 billion in government bonds in an emergency intervention that was never supposed to be necessary. Shadow leverage hiding inside the safest institutions in the country nearly collapsed the British bond market. 6 months later, in March 2023, Credit Suisse was absorbed by UBS. $17 billion in AT1 bonds were wiped to zero, while equity shareholders, who are supposed to lose money first, kept $3.2 billion. The fundamental hierarchy of financial loss was inverted without warning, without vote, without precedent. $275 billion in global AT1 bonds repriced overnight as every investor in the world recalculated what their contracts actually meant. The message was unmistakable. In the shadow system, the rules can change mid-game. And you will be the last to know. Now look at what is building right now. Private credit, the fastest growing segment of the shadow system, has exploded from $875 billion in 2021 to an estimated $1.8 trillion in 2026. These are loans made to mid-sized companies by funds that face almost no disclosure requirements. According to Fitch Ratings, default rates in private credit have been climbing toward 5.8%, and if current trends hold, projections suggest they could reach 8 to 10% by late 2026. Reports indicate that Blackstone's BREIT has faced sustained redemption pressures, with gating mechanisms limiting investor withdrawals. BlackRock has reportedly gated at least one real estate fund. Apollo, according to industry reports, has been acquiring distressed private credit assets at around 45 cents on the dollar. When the smart money is buying your debt for less than half its face value, they are not seeing opportunity, they are pricing in your collapse. But here's what the record actually shows. Goldman Sachs and JP Morgan have reportedly begun building short positions against private credit CLOs. They are constructing instruments designed to profit when these loans fail. Read that again. The largest investment banks on Wall Street are quietly placing bets that the private credit market will implode. This is the same pattern. This is 2007. This is the subprime mortgage short, repackaged and repositioned, but the architecture is identical. The banks who sold the risk are now betting against the people who bought it. Last time, the people who bought it were homeowners. This time, the people who bought it are pension funds, your pension fund. This is where CNBC runs the reassuring segment. Resilient markets, strong fundamentals. This is where your financial advisor sends the quarterly letter that says stay the course. This is where the system tells you to relax, that the professionals have it handled, that regulation has evolved, that 2008 could never happen again. And this is the part where you remember that in 2007, every single one of those voices said the exact same thing. The system always tells you to stay calm. The system needs you calm. Your calm is their exit strategy, because here is what no one in authority will say out loud. There is no formal rescue plan for shadow banking, none. The Federal Reserve has frameworks for bank failures, the FDIC has deposit insurance, there are playbooks, stress tests, resolution protocols. For the shadow system, which now controls half of all global financial assets, there's nothing. Every rescue so far has been improvised, made up on the spot. In 2008, they invented TARP over a weekend. In 2020, the Fed created emergency lending facilities that did not exist the week before. In 2022, the Bank of England reversed its own monetary policy in 48 hours. They improvised because there is no plan, and they will have to improvise again. Except this time, according to early reports, over $265 billion in market capitalization has already been erased from major shadow banking firms in early 2026. The fire is already burning, and the firefighters are still drawing up blueprints. We did not fix 2008, we outsourced it, and the invoice is coming due. The system keeps moving, so do we. Until next time, question the architecture. This was Chapter 2 of Dominion. Begin the full series right here.